So welcome to the Killik & Co podcast for September the 22nd. Last week, as we spoke about, was going to prove to be a very busy week indeed. Not only did we have the Scottish referendum, but I think more importantly for financial markets globally, we had the statement from the FOMC. They had their two-day meeting and the Q&A session afterwards gave an opportunity for people to really probe some of the thinking behind Fed policy at the moment. And whilst initially it was felt that the view was still quite dovish, they still referred to the considerable time before the rates were expected to rise. When one looked at the sort of thinking behind the members as to when rates would rise and how far rates would rise, it just took on a little bit more of a hawkish tone, and that has led to quite a bit of dollar strength, and there are ramifications for that which we'll highlight in some of the following charts. But a quick look at the diary for the week ahead. Well, it promises to be slightly calmer in terms of the fewer economic statistics to worry about, and indeed corporate results are fewer and far between. So just highlighting a couple of things which I think will be relevant. It's at this stage of the cycle of the month that we start to hear about the monthly PMI data, and this is going to cover Chinese, French, German and Eurozone, and also US manufacturing PMI. What is PMI? It is the Purchasing Managers Index. These are forward-looking surveys. They're taken once a month and provide that sort of good and reliable forward indicator and to sort of business confidence at the moment. These are numbers that obviously in America have been holding at resilient highs. They've been very high in the UK, but in Europe it has been a fairly lackluster event so far. So that's going to be of some interest. Really just picking out one or two other highlights for us. In the US, we have results out from a covered stock, which is Nike. So let's get on to some of the charts. Not necessarily all about the Scottish referendum, indeed very few. I think the first is really just take a look at the Commodities Index. This chart is an amalgamation of many of the hard commodities and also covers oil as well. And it is worth noting, really just since the end of June, where this index peaked out around 310, down about 279 at the moment. What is driving it? Well, it is the strength of the dollar, which is making assets, hard assets, and in particular oil, sort of less attractive at the moment. And as we know, commodities were providing much of the inflation that was driven in the early part of the financial crisis. But as this starts to unwind out of the system, is it providing some sort of stimulus to costs, or reflective of a slightly hardening tone towards with future demand? That will all come out, but obviously China plays quite an important role there. But declining commodity prices is something to sort of keep half an eye on. And how's this manifesting itself? We'll take a look at some of these charts to show the sort of low levels being achieved. Silver is now back on the year-to-date lows. And gold also is actually back to some very important core support levels. This level of around $1,200 has been hit a few times, on which it's normally bounced, but gold coming to a very critical path in its pricing. This is what's doing the damage, and we can see here this is the US dollar. It's a dollar basket. So against other currencies, and really just look since the end of June how that has materially improved against other currencies at the moment. And so we're starting to see a fairly material shift in currencies around the world. If we take a look at the US dollar versus the Japanese yen, you may recall that the policy of Japan has been to weaken the yen as much as possible to increase the overseas profits of many of their bigger companies at the moment. As those companies attract more profits back to Japan, higher taxation receipts, it improves the corporation tax profile of Japan, who is desperately short of income at the moment from this source of the market. So the policy is working, and certainly proving to be quite helpful to Japanese equities. We'll come on to that in a second, but also just to say that when you do see dollar strength, you start to see a little bit of a wobble in emerging markets. Nothing too hard to talk about at the moment, but you can see there's been something close to a sort of 4 to 5% drop in emerging market related stocks. This is the MSCI emerging markets chart that I'm putting up, but just giving you a sort of broad reflection that as dollar does rise, we're starting to see some weakness pervading across some of the emerging market equities. This is the Nikkei 225, and that sort of stands outside of the emerging markets naturally, and the weakening currency there is giving a further lift to Japanese stocks at the moment. Markets sort of seeing through some slightly negative GDP numbers, which was driven by the VAT increase, or the tax increase that was imposed back in April of last year. But again, just taking a look at the chart, it is back very close to a year-to-date high. Really that's a good relative performance against other equity markets. So currency being very much the driver of that performance we are seeing. Just a couple of sell recommendations. We came out of Samsung last week, and in terms of its own products, the new Apple iPhone 6 has been selling very well across the globe. Apple putting out some initial order numbers which were as good as expected, and certainly demonstrating that they are leader in class at the moment. Samsung shares suffering. Ask your broker for a copy of the research analyst note on Samsung. And just really on Tesco, to highlight some further worrying news from Tesco this morning. The Deloittes have been in to take a look at the numbers in preparation for the interim results, which were due on the 1st of October. Really just sort of to highlight that when they issued that last trading statement on which the CEO resigned, the guidance for the full year would be that they'd make around 2.4 billion profits for the full year. Well, they've found about £250 million of what they call overstated profits, so it represents around 10 to 11% of that number is overstated. It's a balance of really sort of holding back on costs that should have been credited to the P&L and bringing forward revenues that maybe should not have been, and that sort of combination has resulted in the numbers being overstated. So they're going to take another 3 weeks now to prepare that interim report, and the shares this morning did touch down at around 210, so that was about another 10% off. So the market giving this business no credit at the moment for this warning, 10% adjustment to profits, a 10% decline in the share price. So it's indicative that the market still doesn't feel that this has quite got to the bottom of those numbers. This is something we said back in August of this year. We will keep the commentary going live during the course of the week. So as I say, if you want to sort of follow on Twitter, then you can see sort of updates as they happen.